Good morning, everybody. Welcome to the Locke in Your Success Trade and Market Update. I'm John Locke, and this is for January 20th, 2014. Before we get going, I'd like to remind you that any information in the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, any trades and or results covered in the presentation may or may not be live trades. In the event something is computer simulated, we do the best we can to make sure it is as accurately represented as possible. And also be aware that the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. If you're visiting or watching this on YouTube, come on over to our website, check out our programs, and join our mailing list and get the free report, 7 Secrets to Becoming a Successful Trader, and sign up for the weekly webinar. Okay, let's take a quick look at the market. Last week we were kind of saying that I was short-term bearish, mid-term sideways, and always, as usual, longer-term bullish, because we are longer-term bullish. So last week the market did start off with a decent, or at least the Russell had a decent drop on Monday, and the bulls came right in and bought us right back up. So, and we ended up closing the week slightly higher, but not a lot higher. So as far as what I'm thinking here is that the Russell is still in its sideways range, even though it's pushed slightly higher. As I said before, what I'm looking for is 2 of the other 3 indices to break out with us. And what happened was the NASDAQ did have a pretty good push on Tuesday, and this broke out higher, and this looked like a pretty decent breakout, but by the end of the week we pushed back into range. So we'll have to see where this goes from here. This may be the leader, so we'll have to watch the NASDAQ a little bit. But where it pulled right back to neutral, which would be a common thing. I mean, we break out and we retest, but it really didn't have a whole lot of follow-through. The Russell, like I said, is above its prior highs, but it's just kind of sitting there. And in the meantime, the Dow, it was relatively weak, can't come up to its new highs. So, that's kind of telling me that people are hesitating to buy. And of course, the SPX had trouble. It came right up to its old highs, but it backed right down. So as of right now, we are still in a state of limbo as we've been for the last couple of weeks. My opinion is still the same. I still think the market's going to drop down and retest some more major support levels down in here. Possibly towards the 1775 area. And as far as the Russell goes, this pattern here is fairly similar to this one, where we came up, we ran sideways for a while, we dipped down, we broke slightly higher, and it set in this head and shoulders topping pattern back here in August, and then we broke back down to our support level. So it's kind of looking like that to me until something tells me otherwise, or I see some real buying come into the SPX or the Dow, and they break higher, and the NASDAQ also holds higher, then I'm still of the same opinion that we are coming down. I missed the expiration value this month by quite a bit, first time in a while. But like I said, I thought that we were going to get this pullback a little bit earlier. The market participants have been pretty persistent in keeping the prices up. So usually it will eventually drop out. We'll see what happens. Of course, again, if we do break higher in the other indices, I still only have a high of 1190 or so for a target here. So even a breakout shouldn't be that bad, but I still have the belief that we're coming down for now. And if we're looking at what's going to happen by the expiration month, I'm thinking we close around the downside of this trend line. Because what's going to happen, more than likely, is when we do break down, we are going to finally break this incredibly bullish run that we've had and come a little bit more sideways for a short period of time. So those are my thoughts on the market. If we come on and take a look at our trades, let's start with the January stuff actually. So if I come in and we'll take a look at the January V Condor. And we'll show you what I did with that earlier in the week and how it expired and so forth. So if I come in here and go into the Jan V Condor, and we run into BackTrader to Monday, So one of the things that happened here is obviously the market backed down, and as of Monday, the position hadn't changed any, and this is what it looked like. So I'm pretty much at my maximum profit levels. Remember, we've been rolling out this call because it looked like the market was stalling, and then it fell back. And I was expecting the market to continue back, probably to this area here, and just to expire the trade at this price level. However, on Tuesday, we got that strong bounce. And because, even though I'm bearish on the market and I still think it's coming down, this bounce being this strong and breaking right back to new highs was certainly concerning for me. So on Tuesday, towards the end of the day after this bounce here, I just closed the upside of the position. So I just came in and I sold the long call and I bought back these short calls. So if we come in the end of day Tuesday, the call side is now gone. The put side's still there, but I'm not concerned. There's no point in selling the put for 17 cents, and I'm not going to bother buying these options back for 5 cents. So this is what the position looked like as it expired right here. And we were able to close the month out for about a $5,100 profit. So good month for the V Condor. Normally it pulls about 3,000. 5,100 is a little bit of a bonus for us, so I'm liking that. As far as, let's see, the M3 and the Bearish Butterfly trades, they were already closed prior to the week starting, so that is done. And the last is the January ROCK trade, so we can take a look at that. I'll show you what we look like Monday morning. So we'll come in here, and as of Monday morning, we basically had 10 butterflies at 11:30. We had 10 butterflies at 11:70, and I had 6 up here at 11:90. Delta is relatively flat, and like I said, we're just dealing with the grind. We're up pretty good money, very close to our target. If you look at the analyzed graph, this is what we look like here. Had the market continued to be stagnant, had a very mild pullback or ground up, then profit target would have been easy, but we know that didn't happen. Monday was a fairly good down day, and I wasn't allowing, especially since I was bearish in the market, I wasn't allowing this delta number to get terribly positive. Around 100, I was pulling out, and I was pulling out intraday. So, and I was deciding at this point, 4 days to expiration, if I did have to adjust down, that I was going to adjust this position by scaling out of it. So that being the case, as the market came down, we got rid of these 3 1190 butterflies, and I also got rid of, let's see, I think I got 2 of the 1170s. So if you come to the end of the day, let me see the time here. The last butterflies came off. They actually come off at, yeah, okay, so before the 13, yeah, okay, so right at the end of the day. So here's what we look like at the end of the day. We're kind of back in rock position. We had the 10 1130s still and only 8 1170s, and this is what the position looked like here. And as the market was going to continue to come down, I was going to pull off the 1170s and then just close the position if it got too low on the 1130s. That was my plan. Of course, we had that large bounce on Tuesday, which put us right back up in here again. That being the case, what I ended up doing is just pulling the position down. So that was Monday. And then if we come towards Tuesday at, let's just go to 1300. And you'll see that I started, when the market bounced, I started pulling the 1130s. And as I pulled the 1130s, of course, it pumped up on the other side and made myself, I just kept myself flat delta all day. Then towards the end of the day, I just shut the position down. And that closed out for, all right, here we go. So if we pull the reports, it closed out for 63.73, which was a little bit less than it was up. However, with like I said, these bounces on the bottoms have been really strong, so I just shut the thing down. And I was too close to expiration to try and chase it for only 3 days. So decent return for the ROCK trade for January. And let's see, that's all the January positions we have. Let's take a look at the January results then. So here, remember we closed the butterfly early, the bearish butterfly on January for 12.1% of our planned capital. The M3 ended up closing at 5.8% of planned capital, the ROCK at 12.7% of planned capital, and the V trade at 10.3%. So we had these three trades didn't do quite as well as we liked them to do, but still a very good month. And the V trade did better than normal. So very, very good month for January. And let's see. Pushing to February, we have on the V Condor. So let's take a look at that. Back this out a little bit. This did get one adjustment this week. These positions are so wide that you actually have to, every time we come into the analyze graph, we have to widen them out a little bit. But with the down move, there was no issue here on Monday. And then when we bounced on Tuesday, and then I think Wednesday, if I remember right, it was, yeah, it would have been on this day here on the 15th, which would have been Wednesday. We ended up buying back one of these 1220 puts, calls. Excuse me, I got to shut down option view again. So one of the things with option view, guys, is you cannot, for some reason with the newest updates, you cannot advance your time in BackTrader when you have the analyze graph open, or that happens. So let's shoot into, get this open again. All right, so here we are. We need to go to the February V Condor. All right, so as of Friday afternoon, we had only 14 shorts now at 1220. Delta's minus 73, and we're up about $1,900. So far, the V trade's doing very well. The other open trade that we have is going to be the February M3 trade. So if we shoot out to here, this trade too has been doing perfectly fine. If you look here, there have been no adjustments. I just simply sat in the position as it is. I am carrying a little bit more negative delta than I sometimes do, although after the pullback, we're back to minus 68, so that's normal. But on, I think, Thursday, which was a high day, we were pushing minus 100, but not quite over it. And looking at the analyzed graph now, here's what we look like. Decent shape if we get a push up. And of course, if we pull back like I think we're going to, then this will put this up a reasonable amount of money, and it should be a good month for the month. If not, we'll do the thing we've been doing for the last 12 months approximately, is just chase this, chase the price higher. And the last trade we have open is a February bearish butterfly. We do not have the ROCK trade open yet because it's a little bit early. And the only adjustment to the February bearish butterfly was to add these 1170s into my last third. The price, let's see what day was that. On the 15th, which was Wednesday, the price of the index was up over 1170. That's my last add point. Saying this, I was borderline delta theta ratio issues. I mean, realistically, I could have made a case for rolling my 1130s to 1170 and then adding some 1190s. Certainly, if I was bullish at all, I probably would have went ahead and done that, but I wasn't. So I just added in the 1170s while we were over that level, and we backed down a little bit. So if we look at this position here, it's actually pretty much at break even right now, and everything's fine except I am taking on quite a bit of risk if this breaks out. It's going to be a long trade if the market happens to break out. If the market does what we think it's going to do, then this will pull into the profit target very, very quickly, probably by the end of the week if it pulls back to here. So it could go either way. Now, if I wanted to cover myself, I don't like this and I wanted to cover myself, I could do something like just kind of roll these out. And this is some of the stuff I was doing with some butterflies last month because the market was bullish. I was a little bit bullish. I can come in here, cut my delta number in half. Theta number is still good, and I'm still good if it pulls back, but I'm not going to make my money as fast, certainly, if it pulls back into here. But I've also shaved off a lot of my upside risk in here. So things like this you can do if you're overly concerned about the upside. This being a guidelines trade, we're just doing it by guidelines, so we shall see if the market breaks out. Like I said, next roll point's actually 1180. However, we may start hitting maximum delta numbers relatively quickly if we do not, if the market goes up, and we'll end up rolling ahead of time. So that is all the trades. I didn't know if there are any questions that anybody had on anything. And if there are, I'm open to them now. Was there an extra upside? Oh, no, there wasn't. What the January V Condor had was I ended up rolling out the call, but I didn't roll the put. So if we look here, January V Condor, one of the things I'm not sure whether, okay, so I was widening the straddle here on the 2nd. And then on the 10th, I only moved the call from 1140 to 1170. I didn't move the put. And the reason I didn't move the put is because there was no value in it, and there was no advantage to doing it. So I just left it alone. Obviously, the short puts were worthless also. But yeah, no, it never had an extra call. We sold 15. This is just the process of widening the straddle and moving the call around. Okay, is there anything else? What graph had a big boost, Andrew? Did it? Did I, let's see. No, I have everything written in here. It had a big boost where? I mean, unless this gave me a bad number somewhere. 5160. Let's go to, oh, right here? Oh, okay, yeah, that's not from extra calls. I bought back the puts. I mean, I'm sorry, I bought back all the short calls that were at 12 down here. I never sold the long calls because I couldn't get any money for them. So one of the things you'll find when you start closing these next to expiration is sometimes it's actually more money to buy back the spread than it is to buy back the call. They actually make you pay extra money to get out of the because you can't sell the 1230 calls sometimes because they're too far out of the money. So yeah, those are just hanging around. All right. If I had entered a rock, would I lean the 1154? Okay. Yeah. So some people do play with. This looks like it says if I had entered a rock trade, would I lean to the 1150 for better open interest? And I'm assuming you're looking at a February. And the bid-ask spread versus the 1150. All right. So the market maker is just going to make a market for you. And I have some clients who play the bid-ask spreads, and they have all kinds of crazy spreadsheets and stuff to deal with that. I find they ultimately don't do better than anybody else. But you know, if that's something you want to spend your time with, that's fine. But if you're having this February open interest at 1150 is going to be, it's adequate, and maybe you'll spend a few more cents or whatever to get into it. But I'd rather have my positioning the way I want it than try to go someplace. In other words, I'd rather be positioned in the graph the way I want. So when I'm determining where I want to enter a rock trade, for example, I might take my charting into consideration. I might say with the Russell that I think this is going to happen or I think that's going to happen. And from there, I might want to be in different strikes, but I'm not going to let the open interest dictate where I enter. I'm going to enter where I want to. So the answer is, so specifically to your question is no, I wouldn't lean to it unless for some reason the for some reason the charting's telling me, or I have some sort of an opinion saying that the market's going to do this or that, in which case that'll make me lean one way or the other. So, and I do tend to stay out of the 5-point strikes. I know you said versus 1165. It's just easier for me to trade that way. It's not that I wouldn't do a 5-point strike, but I usually stay with the 10-point strikes. All right. So, okay, some of us entered the February bearish butterfly at 1140 and are still in 1/3. Yeah, right. If you have 1140, you don't go to 1180. Yes. Let's look at a February bearish butterfly entered at 1140. I just want to take a look at this and see what it's going to look like. So are you up money or down money? Okay, so you're pretty flat. Yeah, that makes sense. 1, 2, 3, 4. Right, so you're looking at something like this, and you're about flat, so that's fine. One of the things on when I'm single positioned, and this really isn't in the guidelines, but one of the things when I'm single positioned, I don't like my delta much more than 150. And that being the case, we're at 193. So you can do a couple things here. You can either, you could roll up to at the money. However, if you have some sort of an opinion that the market's coming down or you want to leave yourself some room, then, in other words, you just kind of jump the gun and do a roll as if you had maximum delta. Or you can, your delta theta ratio is fine. Or like if you had a delta theta ratio problem, you can go ahead and skip to 1160. Another thing you can do is say, because as you sit here, day after day, week after week, and the market just hangs here, you are starting to take on more and more upside risk. The other thing you can do is you can say, all right, I'm going to treat this a little bit more like an M3 type of a position, and I'm going to cut my delta down to maybe minus 125, because I don't like to hang with 1/3 of a position in a 10 lot more than 150. So, even something as small as pulling this out will cut me down to minus 130, and it still leaves me a decent downside move. So when the market does hit my add point of 1180, you're not down as much money, but from there, knowing that you had this issue, if the market does hit your 1180, I would definitely roll to the 1160 and then add the 1180. So I would do a delta theta roll before it goes, and then I would run the trade as regular from there. So just gradually put verticals in, cut your delta under 150. Market swings back, you're fine. If you end up having to swing back a lot, you can always pull them back out. If the market just kind of sits here, like I said, keep it under. And if the market shoots up over your add, I'd roll and add the position. So hopefully that makes sense. But that's pretty much covers most of the things that can happen to you. Okay, so of course the February ROCK IV. Okay, so here's a question. From the course, the February ROCK IV check would suggest closer to the underlying, perhaps 1160, i.e. less than 20 points to the downside for the shorts of the put butterfly. All right, so I'm assuming you want to enter early, and I'm assuming you want to enter a ROCK trade. So here, let's just go off Friday numbers at 3:30. Let me just clear these trades. Okay, so if I have a ROCK trade at, let's just look at the 1150, because I haven't even looked at the entry yet because I'm not ready to enter, but let's just take a look at who we had been looking at an entry on Friday. 2, 3. Okay, so what I'm going to do is I'm going to come in here. I have my shorts at 1160. I want to know what the delta is at I'm sorry, my shorts at 1150. I want my deltas at 1170. This right now is actually telling us to run an M3 entry. I want a delta of at least minus 180, so this is kind of actually borderline, minus 180. So from the course standpoint, the course material standpoint, if you were to enter 35 days to expiration, it would tell you to enter as an M3 trade. Now, I'm going to just look at entering it some other ways also, but that's what it would tell you, which is pretty normal. So for an M3, pretty much if you enter, unless the volatility is extremely, extremely low, if you went to a ROCK trade early, it's almost always going to tell you to go revert back to an M3 trade. There are ways you can enter this as a ROCK trade, but we have to change our delta theta guidelines and stuff like that. And we also have to take into account the positioning of where we are into the position if you're going to enter early, and you're going to ignore delta theta guideline, the delta guidelines. If I was going to do a ROCK trade and I was perhaps thinking, so this is taking technical analysis into things. If I'm thinking that, and this is a real life scenario, right? If I'm thinking that the market's going to top out at 1190 or 1200, and I'm also thinking I have a decent amount of downside risk, then I'd want to position myself, if I can, so that, let's see, we're at 1170 approximately, so that when I'm fully scaled in, I'm at 1210, and let's see, can I do that? Let's see if I can do that. So if I'm 1168 and I want to put my top at 1210, that's going to 60 points down from 1210 is 1150. So that means I'd want to enter at 1150, because if I did backwards in this, if I entered at 1150 and I added in my 1210s, no, I'm sorry, I'd add in my 1190s, and I got fully scaled in at 1210. That means if I get my move to 1190, I'm going to be in the perfect spot to make the maximum amount of money. And if I actually enter here, I'm still giving myself some downside room. So because I'm a little bit bearish, my initial entry would be slightly more negative delta than normal. But if I'm wrong, at least my T plus 0 line is gaining some value up here. And when the market takes off, I can scale fully in. And if like I said, if I'm wrong with my downside judgment, then I can scoot into my 1150, 1190, 1210s. And then, of course, if it comes down, we simply roll back into ROCK with a half rollback, and we take advantage of the market coming down into here. So I don't know if you can kind of picture that in your head, but if I came in here and did these, and I came in here, I did some 1190s, and we'll just look at 5. That's what I mean by a little bit of bias in the charting. I want to be at the strikes I want to be at. I think 1150 entry, if I was going to do it today, is be a very good entry because of where I think the market's going. And I'm not going to pick the 1160 and go closer, especially I think the market's dropping down. Because if I pick the 1160 and I go into the 1200s and the market does what I think it's going to do, it's going to toast me. So if it comes down hard. Right, not that I'm protecting the market, but I'm just biasing something slightly towards what I want. So something like this can withstand a decent sized down move before you get into trouble, 1140. I could even go maybe even a little bit less. And of course, if I'm wrong and the market goes up, like I said, we'll be scaling into these, scaling into those. And as long as the move is reasonably fast, reasonably not explosive, I should say. As long as the move is not explosive, then we should be able to keep up with this to 1190 or even 1200 without a problem. So those are my comments on that. And just, all right, so are there any other questions? I had a couple of email questions, but what I'm going to do is save them because there's nothing urgent, so we'll save them for next week because we're kind of running out of time. I hope everybody enjoys their day off with the the market closed today, and I'm looking forward to talking to you guys next week. So have a great week, everybody. Thank you, and goodbye.